Hi, Lee Phillips here. I'm an attorney. Don't hold that against me. I want to talk to you for a minute about funding your little company. Everybody puts money into the company when it's created, and in the old days you used to have $1,000 in a bank account or some such thing because they wanted to see when you created the corporation. It's almost before LLCs, that's how far it goes back. But they wanted to make sure that you had sufficient funding to at least start the company. And by the way, one of the biggest issues in lawsuits associated with small companies and the people who invest in them is the fact that the company was underfunded to begin with. It had no chance of doing what it was supposed to be doing because there just wasn't enough money. We'll assume you're okay with that. You have enough money to start the company. You've got your $1,000 in the bank account or whatever it is. Most states don't require any specific funding level anymore. But you've got some money and you're going along fat, dumb, and happy. And then the company needs some more money. Oh, and by the way, when you originally set up the company, you put your $1,000 in or whatever you started it with, your $10,000. Your piece of property, that's money. Whatever you started the company with, you gave the company that money, that property. You'd better be getting property back in exchange. What do you get back from a company? You get stock if it's a corporation, or you get membership interests if it's an LLC. When I give IBM my $100 in green, I want $100 in blue back. I want a stock certificate. Your company had better deal with you the same as you would expect IBM or any big company to deal with you when you gave them money. I get something back. And by the way, that's important to the IRS because that's an even exchange of value. I gave $100 in green. I got $100 in blue back. No tax to either party on that transaction. And if you don't do that, then there's a tax consequence. But I've funded the company, I've started it, now I need to give the company more money, and that's not uncommon. How do I do that? Well, you can give the company more money and you can get more stock back. Or it's going to go to increase what we call your capital account, the bank account that you have with the company. One of the issues is, I see it all the time, people don't plan on having the company fail. The fact of the matter is, the vast majority of companies fail. It's huge. Well, when a company fails, there is a pecking order as to who gets money back when the company fails. Guess what? The stockholders, the members, the owners, they're on the bottom of the barrel. Who's on the top? Well, a secured loan holder would be on the top. Their loan to the company is actually secured by the company equipment, the piece of property the company owns. It's somehow secured. And they get their money back first. So if I have to put another $10,000 into the company to make it work, maybe I'd be better off to give the company a loan. Now, if you're going to give the company a loan, it's got to be a loan. I want to see the note. The note has the borrower's name. It has the lender's name. It has when you're going to pay it back. It has the interest rate. It has the dates. It has everything else on it. I need a real loan document, a note. And I've got the note. If it's going to have collateral security, then we've got to say in the note what the security is, the piece of equipment, the house that's in the LLC, whatever it is, we have to have that listed. And sometimes if it's a piece of property, real property, you ought to file on that. If it's equipment, then you're going to file a UCC filing, is what they call it, Uniform Commercial Code. You're going to file under the Uniform Commercial Code, and that's going to lock that piece of equipment down so that if the company goes bad, you get that piece of equipment to satisfy your note. It's maybe a whole lot better not to just give the company money and get stock back or increase your capital account. It's better to give the company a loan, even secured, and then get the note back. That means you're in a lot better position if the company starts to go south. And you're probably a little bit cleaner with the IRS too. We don't worry about the capital accounts and all of that stuff. We can take money out of the company as an interest payment rather than as wage, which means you save the Social Security, FICA, FUTA, and all that garbage on it. Yeah, you got to pay income tax on it, but you don't have to pay what I call the social taxes. So you're transferring money out of the company in a tax-advantaged way when they pay the interest on the loan. You get a secured position in the company property if the company starts to go south. I just think it's a lot better in most cases to make the company a loan, get the note back, secure it. It's just a lot easier. This is Lee Phillips, just with a thought about how you might be funding your company.